We're looking at a chart in the gold market here, trading last at 1855, down 20. We have a fast market conditions here from the sell one level. We've activated actually a short trigger from 1868. A couple of signals were issued from that level this morning at about 3:15 a.m. and also 2 or 3:15 a.m. Which is, I guess, the reason why I woke up at that time. So if you were trading Globex or in Europe, according to your schedule of trading here, you would have been able to take advantage of the signal. Unfortunately, for most of us, unless you trade, Globex, the VCPMI is like a little rabbit, ever-ready rabbit that keeps on ticking. The VCPMI keeps on trading, keeps on providing entry points, exit points. It keeps on providing trigger points for you as a self-directed individual to be able to trade the market. So what we have here is basically the market has activated a short trigger from 1868. The target automatically identified as the daily average price of 1848. Now, one of the things that we're looking at here is the market at 1849 seems to be harmonically aligning the daily and the weekly average. So this would be the area of the first target that we're looking at for the day. So let's watch the market here and see what it gives us for the day. But so far, the signal is a short trigger from 1868 with a target of 1849, 1848. Testing. Okay. Let's continue to watch the market here once again as the market begins to identify. We have locked in pretty much a profit of $680 on the trade. The short trade was activated early this morning from 1867.50 actually up here, but a couple of times you had the opportunity to go short. If you follow the short position here, you can trail it with a stop, a trading stop. But you know, for $680 on a quick trade this morning so far, within the 15 minutes, you might say, or 45 minutes of opening the market, I think that's a pretty good deal. So continue to watch this market here as the market trades into what appears to be a harmonic level. The monthly and daily are matching at about 1849.48. So this would be the level that we want to keep an eye on and see what the energy is, or what the you might say supply and demand paper is there. Let's continue to watch the market. We are flat. We're flat for the day right now on the day trading signal here. Now, when you go flat, I don't usually jump right into the trade until the algorithm identifies the highest probability trades. I really am disciplined and adhere to executing only the highest probability trades. And that's pretty much the market. After it completes the target, it reverts back from that target. And so this is the principle of the reversion to the mean. And that means essentially that the markets, mathematically speaking, economically speaking, even during a day trading range, can extrapolate the extreme level above that average price. And upon completion of that price, the market usually will revert back to test that average price. Now, what makes the market obviously is the paper, the supply and demand, the buyers against the sellers. And the only thing that the algorithm pretty much identifies with extreme probabilities, accurate probabilities, is when that supply or demand, economically speaking, is going to show up. And here, obviously, it identifies sellers. Sure enough, the market validated that. But our traders had this information ahead of time, and can use this at your discretion. I come back to the analogy that I use this as a GPS to identify what I'm going to drive today. You know, if I don't have a signal, obviously I wait for the signal to be activated. The way that I trade the algorithm, as I said, is pretty much I buy from the extreme below the mean. And in this case, the market came into this 1820 area here yesterday, making a low of 1820. And what you see here is approximately the harmonic level that we have between the buy 2 level on the daily and the weekly buy 1 level. And what we're talking about is basically integrating the probability factor of the daily signal that is a 95% relative to the implied volatility to the mean, in conjunction with a weekly buy signal, which is a 90% probability to the relative implied volatility to the mean, which is 1849. So you're getting a 90 and 95% signal daily and weekly that the market is, could revert back to the mean, or should revert back to the mean when the signal was activated here. What you see here is the resolution of that algorithm. Boom, the target was completed. Now, from 1820 low, and by the way, our traders, or if you look even on the videos that I do every morning as a courtesy to you guys, we've caught some really great moves. But I maintain a continuous coverage of the signal and follow through, you might say, through the private trading room that we manage, literally 23 hours a day, besides getting this information prospectively. And so I do make a very strong effort, obviously, to share this this intelligence that, it certainly works for me. And if you follow the discipline and the consistency, you might say, that the algorithm provides in terms of identifying the intelligence to execute, I think you're going to be way ahead of the game, instead of using, you might say, your emotions, which is what the majority of traders do. So here, it met the target. In terms of the futures contract, I go neutral, but I do keep a long bias. I do keep a core position. I trade the market long term, short term, and day trade the market, as I'm teaching you and doing here. But the application of the VCPMI is exponential. You can apply it, as I said, for your intermediate to longer term trading. As far as day trading is concerned, what you see here is the signal went neutral, and now you're waiting as a day trading, trader for the next highest probability signal. Okay, so but if you translate, the intelligence tells you that by the market coming back above the average now, after completing the previous trend, and closes above 1848, it's a pretty strong signal. And we've looked at this, why, and when you want to look at in terms of the bigger trends, and you're looking at the average of 1840 that we've been working with, and this average price was the monthly average price. And so trading, when it went up above 1840, 49, it brought in the daily, the weekly, and the monthly trends. And on the monthly, if we use the monthly trend, and you're looking at a target of 1913, $18.40 is the average price. It market closing above it activated a bullish trend momentum with a target of 1913. This is the overriding longer term signal that you see. And obviously, when the market closed below, it activated a bearish trend activating 1820 now as the higher low from the previous low that we made of 1867, which is the beginning of, I believe, of so far looking like we could be looking at the bottom so far of the year. The annual low of this year so far potentially could be 1767. Now, what you see on the daily here is a combination of different indicators, Fibonacci retracement, Fibonacci fans that are integrated into the monthly codes, and we include the 360-day cycle of 1810. And so this is a pretty detailed picture as far as I'm concerned in terms of how to drive this puppy, how to drive this market. On the bigger picture, you got a descending wedge, which is bullish. The market broke above this descending wedge and pretty much got up right into the Fibonacci fan trend line, reverted from there, came right back down into the buy zone of the monthly 1840. The yearly was at 1810. So this is where, I am accumulating longs at this level here. And I recommend that this is the level where you want to add to your long-term position, add to the market. What you see here is the market trading now off the Fibonacci trend line. And right above it, you're looking at the monthly sell one level of 1913. If it does break and close above this Fibonacci trend line resistance of 1868, then the 1913 is a very good probability that it will be accomplished. What we see here is that the market on the longer term basically is trading around a 38% Fibonacci retracement. Now it's come back up from that 50% Fibonacci correction from the lows in March to the recent highs of 2089. This was the 50% correction of what appears to be this the second wave, the second leg, possibly the second movement that has been identified. Potentially, as I said, to be the bottom or the annual low for 2020. So we're looking at a significant turning point. And what I'm doing here is letting the market validate as we end this year, whether that is going to be in fact true by simply the action of the market that we're looking at currently. So once again, we've run up from this low, activated this leg short term that got us up to 1879, 1880, rounding it off. That pretty much was right into the Fibonacci trendline resistance level, and it met some of our earlier forecasts using the VCPMI. Reverted, found buyers again on a secondary low, which was that 1820 low. Now it reverted right back up again to test this previous high and the supply up here, which is really what it's testing. So far, it hasn't been able to get through this. It's still, early for the day, but this is the level that will validate that if it closes above here, then you're looking at 1913. So far, it looks like we got supply coming into the market. This is the trading chart for me. So let me go back here to the shorter term chart here. You can see a little more clearly the patterns that are developed here. So, I'm comfortable, as I said, holding my current position. I've taken some profits off the table. I've recommended my traders in my private trading room to do the same and to begin to hedge up here, begin to lock in. I don't believe, based on the technicals of the market, that the market is ready to go yet. But I could be wrong. So what I do, if that is the case, there's always the possibility, that I could be wrong. The market always has the odds and to prove you wrong. But the whole idea is how you manage that possible risk. And so, in terms of the position that I would suggest, if we're looking at this possible, test, you might say, is to go into this period, going into the holiday, the year-end holiday, tax selling, and all this other technical fundamental stuff that's going to come in. Go in there synthetically long. You can use strategies where you can sell out of the money calls, raise equity against your current position that you have. You can trade around your position, depending upon your skills as a trader, besides just trading in the futures contract or day trading. It's a fantastic market. And I think, the fundamentals pretty much that we're dealing with right now are so skewed, conflicting, politically, inclined, more than economically inclined, and a lot of rhetoric as we move into the end of the year. And so there's still a lot of risk in terms of the market, fundamentally speaking. But sometimes the market, as you know, if you've been trading this for a little while, doesn't necessarily follow the fundamentals. The talk of stimulus is pretty much dominating the headlines, and it has gotten the sentiment of the market pretty bullish. And when the sentiment of the market is at the highest peak in terms of being bullish or bearish, and that sentiment matches the distribution area of supply, what we have seen consistently is that the supply that is offered up here is record level supply, particularly when you get the alignment on all of the trends. And that's pretty much identifying the algorithm that is a contrarian algorithm. it's contrarian to the sentiment, and that's how you make money in trading. You don't follow the herd. You do the opposite of what everybody else is doing. And there are a lot of markets right now, particularly like Bitcoin, that are trading at record levels, record sentiment in the market. And, you know, it looks to me more like some kind of a blow up stage, but yet it's a tradable asset. It's got the volatility, and if you're willing to take the risk, you know, when you bought it at 10,788, it's at 20,000. So you've doubled that since October. It's a fantastic, incredible instrument. GBTC 2563, you know, it looks like it's even breaking out of all of these indicators. We might as well clear the chart and begin to calculate from scratch, you might say, the dimensions of the market. So here we have the trend line resistance into the 26, you know, the 26 level. If we do the lower channel, you're looking at this magnificent uptrend channel that you can see clearly the market has begun to trade in between this channel and seems to be trading on the upper end of this channel here. So, you know, as a trader, you know, I would be interested in buying the market into this 2081 area, you know. Obviously, it confirmed that the market held this uptrend channel. Pretty exciting market. It gives you a lot of flexibility to trade if you're a trader, if you're looking for a tradable asset, if you're looking for volatility. But it is not a currency, which is what a lot of people are talking about here in the internet. You know, arguing whether Bitcoin is taking traders away from the gold market, which I believe is the opposite. It should be the opposite. Even though you know you might have a portfolio where you trade virtual currencies or Bitcoin for that matter, I don't believe as of yet, if you just look at the legalities of it, for example, gold is a tier 1 asset. You can buy 100 ounces of gold and you can go out and use it as collateral and borrow against it. But you can't buy 100 Bitcoins and go to a bank yet. I'm not saying that they're not going to, because they are trying to implement, obviously, a virtual currency as a form of exchange outside of using the US dollar as a reserve currency. And this has created that opportunity for you to use what it's called a virtual asset, a virtual currency, as opposed to a fiat currency, which is the paper asset that we use. But it is not a currency, a real currency. It cannot be used as collateral, and until such time, it will only be a tradable asset, a virtual asset. And, you know, if, you know, moving into the future, obviously it makes perfect sense that if we create this virtual world, that, you know, we can't really use fiat currency, although we can transfer, electronically, but um, I think the demand is trying to create a virtual currency that can be used in this virtual economy that we're creating. So, when you think about, why is it that all of a sudden we have this flurry of virtual currencies uh, come out into the market that are trying to be substitutes for the US dollar, is because the US dollar is at jeopardy of maintaining its world's reserve currency. I mean, that in itself is telling you that people are looking for other alternatives than to hold money in US fiat currency. And unfortunately, uh, I think it's just a reflection of the future, you might say, of the US dollar as the world's reserve currency that is being challenged not only by investors, but also governments and institutions in terms of replacing it as a tradable asset where you can hold your cash balances as opposed to holding it in US dollars. Cash in US dollars has a silent killer behind it, basically, and that's called inflation. And the more that they create stimulus, the more that they print money as the economic system collapses on the face of this pandemic, that even though we have some possibilities down the road, we can see the light at the end of the tunnel with vaccines and so on, we still haven't seen yet the true damage economically that this has caused. And there's still a lot of premium to put on instruments that are risk assets, safe haven assets, like gold. And obviously, um, you know, runaway runaway investors are flocking into Bitcoin. The mere fact, I want to say that Bitcoin is so overwhelmingly uh, publicized and talked about on the internet, on just about every uh, news entity out there, uh, is a cautionary sign for you if you're looking to invest in the market. This is not the best time for you to enter into the virtual market and begin to trade currencies at this point. Let everybody have this uh, frenzy. You don't buy in a frenzy. You sell the frenzy and you buy actually the pessimism. That's how you make money trading the markets. And to me, being around after a little while and showing you, I can show you my scars, you might say, it's a cautionary sign for me that I don't want to follow the majority, the herd. Market is extremely overbought. There's gaps in between that will be filled. And when they are filled, and the indicators point to a more fair value and ideally undervalued level, I may consider again uh, trading. And we've done very well in trading. So I'm comfortable in focusing my trades on gold, silver, the E-mini, and GBTC that we've added actively. So coming back to the gold market here, you see the resistance level being offered, pretty much market, not having the ability to decisively go through this. This is a lot of resistance, a lot of supply to overtake. Um, and, you know, I'm patiently waiting for this to resolve itself, ideally into this blue levels, which I think we're looking at the harmonics again at 1820. As the first test. And as we saw today, it was a pretty good test. Um, and this is where we are. So let's watch the market here. Let it trade a little bit here, and I'll continue to update you. Pretty quiet across the board. Silver came down to that weekly 24.85, so close below 24.85 would activate a short trigger in silver. So it's right now in no man's land. We don't buy above the sell one levels, which is the distribution area. So we pretty much are holding status quo here for the time being. The one thing I can say to you, the market, the longer that it takes to move or go in one direction here, a lot of the buyers that bought down here are going to get nervous if they didn't take profits. And so you begin to formulate another pattern developing here, which is from the high here of 1868, you're looking at maybe to the low that we saw of 53. You're looking at 67 to 53. You're looking at a $1,300, dollar range, which potentially could be the going into wave analysis, unless the market breaks through this. It could be this could be a corrective wave up, which means that unless it breaks through this, you can see it begins to unfold into the next wave. So analyzing the market micro, analysis, so to speak, it does move in wave patterns, wave counts, starting from the smallest time frame to the largest time frame into the cycles. So in trying to define, what to do here, you can see what the market is doing if you're just using conventional technical analysis, that it's breaking out of this and showing potentially again a rally. And this is, pretty much how you identify the wave counts. It doesn't mean that, for me anyway, that I had to take every one of them, but this is how I identify the patterns easily. Now, if we come back down again below this level here, the probabilities are increasing again that what you're looking up here is supply coming into the market. And it will be reflected in the price, as you see in the red bars. If we get through this, and in green bars, ideally big bars, green, then it means that you got buyers that are greater than the selling pressure or supply that's coming into the market. It's all about supply and demand and how you manage the risk in identifying the extreme levels so that you, as a self-directed trader, can take advantage in executing the highest probability trades. What I'm recommending here, pretty much, and what I'm doing here is for myself, as I said, I'm fading these rallies into ideally 1874. I'm not buying into the sentiment up here. I'm trading against this extremely bullish sentiment that you are seeing out there on the internet. And I am interested in buying the market as we come down to a fair value, ideally undervalued. Continue to hold on to your hedged positions up here. And if you're trading on the long side, do it short term and use these rallies once again to unload some of the profits, manage your position in a way that you don't get out of the market from your core position, but you manage it intelligently, synthetically, that will allow you and give you opportunities for you to take advantage of these short-term corrections that we move in the market. I think Christmas came in early for us. I think Christmas came in on the 15th. In terms of actually locking in values, okay. But I want to say to you that I hope that Santa Claus can bring us the levels, ideally even of 1810 to 1820 again, into Christmas time, which will be a fantastic buy-in opportunity for the holidays, not only for the holidays, but for the next seasonal pattern, for the beginning of the seasonal pattern for 2021. That I believe is going to be very, very exciting. And I think we're going to see a lot of surprises as we move into January. Thank you again for the privilege of your time in sharing this information. And I hope that once again, every day that you come here live streaming every day, you become a better trader. Take care. Be well. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.